Scott, thanks for taking out the time today and chatting with us. Before we get into it, I just wanted to see if you can give some background to our listeners on you, who you are, what you do in real estate, and then we can kind of go from there.
I appreciate it. Thanks for having me, Peter, on the show. I've been looking forward to this. So a little bit of background about myself. I began in real estate in 1991, get my master's in architecture. And I was fortunate enough to have a professor that was actually working on real projects. And so my master's thesis was a project that he was working on, which was 400 units, $100 million in revenue. So I'd work on with him in his office in the morning and then work on it in the afternoon in the studio and then go home and do homework for him until about midnight. So that was my routine for about 3 years. And then I continued working with him for another 3 years. And then 1998, I began the first of our companies, Coda Design Build. And we focused on development and design and construction of different projects, predominantly single family and multifamily in its use. And then in 13, after the crash, I started Coda Management Group with the focus of investment commercial properties. And then most recently, within the last 6 months, we just started one-stop self-storage. So we're now managing our own facilities as opposed to having third-party REITs manage them. And so it's been a little bit of progression, but we've done everything from single family to multifamily, mixed use, commercial, flex warehouse, and now self-storage.
Nice. So take me back and, 92.3 when you're basically shadowing and getting mentored, what would you say? I mean, because a lot of our listeners are listening to this podcast and other podcasts to get, a distance mentoring. Someone that is in their shoes were in your shoes then, how do you find a mentor or at least, start working underneath someone that would be able to help you in your future career?
Well, I've been fortunate enough to have a couple mentors in my life. The first one was obviously my professor, so I was paying for the education.
Yeah.
And then when I became his TA, I negotiated. He's like, "Well, you have to work for me for free." And I'm like, "Well, my TA shift says I work for free for 20 hours, and then after that, you have to pay me." So that was my first negotiations in real estate. I learned the nuts and bolts, the ins and outs of real estate development underneath him.
Mm-hmm.
And then the second mentor is my business mentor. And I was fortunate enough to be introduced to him, and I joined his IQ program, which he called. And, I paid for that as well. I'm a big proponent of, you get what you pay for. And you can certainly learn a lot online. There's a lot of information and resources. But if you're trying to really develop and take it to the next level, you have to be willing to give something up to the person because their time is, valuable. And so whether that's working for someone and you might take a lower pay cut or, getting that exposure or paying someone to hire them as a consultant or whatever it may be, I think it shows your commitment to them, but it also shows their commitment to you. And so, that's how I've done it. And that's, something I believe in. I see a lot of discussions and arguments about whether or not it's worthwhile. I think that's just a matter of, what you want to put into it. So,
Yeah, I agree. It's adding value to that person. And also, like you said, what you want to put into it, what you're able to put into it, and ultimately that's what you're going to get out of it. So if you put, if you do 50% effort, you're ultimately going to get that 50% back. But if you do that 110%, you're going to be able to get that, for the time that you're with that person. And ultimately it's going to serve you for the next, 20, 30, 40 years in your career.
Absolutely. I mean, I taught college architecture. And, at the beginning of the class, we'd always ask the students what they want out of it. And, a majority of them would say, "I want an A." And we said, "Okay, well, we don't give A's."
Yeah.
You earn an A. We don't give gifts. We don't give A's. We don't give B's. We don't give C's. You earn each of those grades. So if you're committed to it, we're going to tell you exactly how to get an A. And if you fulfill these things, then you'll get an A. If not, then you'll get a B or C or D or E or, or an F. And so I think it's the same sort of concept. If you put the time and the effort into it, then you'll see the results in your company. But there's a lot of people who don't, won't make that commitment.
Yeah, for sure. Especially, at least my experience, it's usually until people get a little bit older, they're willing to put towards that effort. Usually when you're a little bit younger, you don't see what that ultimately will reap you later down the road, right? You're ultimately not willing to put that sacrifice in. Some people are, very few are, but then the older you get, you're like, man, I should have put that time in, or, I didn't then, now I'm going to do it right now. So
Absolutely.
So for you, going through the years, and now you guys are doing, self-storage, all that other stuff. What are some things over the career that you've had, 30 years plus? What are some things that really set you apart versus, your competition when you were growing up, through the business, and how are you able to utilize those strengths going forward, in each of your endeavors?
Well, I don't think there's too many of my competitors who act as the developer, have the design background, can facilitate the design, as well as understand the construction. And now we're getting into the management of the assets as well. Typically those roles are split up and divided amongst different people. But, when we look at something when I'm designing something, I'm looking at it as a point of view of a developer, as well as the point of view of a contractor, to say, okay, is this design going to cost too much within the budget? And so, we're constantly looking at those lenses of three different perspectives, while many others are just looking at it from the one perspective. Well, I don't understand the design. I got this drawing and now it's coming over budget. How do we deal with it? We're steps ahead of that because we're not designing something that's going to come in over budget. We're very conscientious of that and making sure that there is an alignment between all three disciplines.
Okay. And so designing, doing all the permits, structural engineering, and stuff like that. How are you guys able to do that? Is it because you guys know those aspects so well, or is it a little bit about knowing those aspects really well and then also knowing the area that you guys are going to be investing into? Just to give our listeners some more context on that.
Well, the original definition of an architect is master builder. And so the master builder is, someone that understands all of it, but is not actually proficient in any of it. So that is inherently, you're a jack of all trades of knowing a little bit about everything. Yeah. So to answer your first question, we were designing our latest project in the mechanic. We have to hire local professionals in each state. So, we come up with the design and then we're hiring the locals to work with us to make sure that we're complying with the local codes and, the licensings and all those sorts of things. So we were talking with the local mechanical engineer in Louisville, and, we're like, this design is going to cost us way too much money. I mean, this is just way beyond what we're projecting or trying to do. And they're like, well, how do you figure it? And I said, well, I could go through, solar orientation. I could go with heat gain. I could go through and then talk about the fact that what we were trying to do, and said, why don't we just break it up into smaller little systems like this because of this assembly type? And they're like, oh yeah, I guess that could work. But more importantly, we weren't taking up huge gobs of floor space, which was then reducing my net rentable square footage. And that, if by elevating it, getting it off the floor with smaller systems, we could then rent more of the space, which then increased my income, which then increased, the performance of my project. If I hadn't had that perspective of the developer of my loss of income, then we would have allowed that HVAC system to occur. And I mean, it was significant. We were taking up like 20% of our floor space. So think about taking 20% of your income right off the top. That's a big difference. So those are the types of things that how we look at it to make sure that we're in compliance, but we use our past experience. We look at how we've done other buildings. We look at, how we have modeled out other systems, and we look at those KPIs very closely. So when we buy the building, we're taking those things into consideration.
Gotcha. And how long, over the years of experience, how long did it take you to kind of like say, have that confidence of saying, okay, well, 123 Main Street's gonna be this much under budget because this is what our systems show. How long did it take to actually get that system into place to say, I can look at 123 Main Street or 123 Orange Street across two states and know that it's going to be this amount of money? Did it take, a couple of years? And how were you able to build that?
Well, you asked me how much confidence. I think maybe it was stupidity at the front end because
Yeah.
we didn't have the confidence, but we were certainly, still had the same belief, right? We're like, okay,
Yeah.
it's going to cost this amount of money. When we first began, it was more along the lines that we were looking at price per square foot. And so when we began modeling things out, we're like, okay, this is so much. We've done other projects like this that are similar. And so we were we were always, our frame of reference was always based upon a metrics. So whether it be price per square foot or price per unit or something along those lines where we could break it down. And I think we might not have been perfect at the beginning, but we had enough confidence to move forward.
Yeah.
And so I would say, under self-storage, we've done enough building type techniques that we have concrete down, we have a framed structure down, multiple stories. We've done 8 stories. We've done 9, including the basement, but we've done 3 or 4 stories. And so we have enough to rely upon that we can say, okay, this is the type, and we can relate those buildings back. So I would say it took us 3 years within self-storage to become pretty confident just because we had to do a range of building techniques.
Yeah. What do you guys like about self-storage so much?
Well, it's a lot more predictable than single family and multifamily. I mean, we can model out supply and demand. We can see the forecast. We can see the demographics a lot more specifically than what we're able to do with multifamily. For me, it's no different than multifamily, except it's apartments without toilets. It's apartments without plumbing. It's the most simplistic version of it. But the business model is a lot more predictable, and we can model it a lot better than what we could have ever done with multifamily.
So, and that's all, every time I talk to someone that does self-storage, that's all that they talk about and rave about, is, the no toilets, being able to kick people out, a lot quicker than you can evict somebody. So those things are huge. When did you guys start getting into, focusing on self-storage?
That was in 2013.
Okay.
That was our first conversion.
Okay. And so that's, back when, even though, they were popular and a lot of people liked them, it wasn't where this craze is, I would say, the last 3 to 4 years. And you could probably speak on that a little bit more. But in the last 3 to 4 years, everybody's really jumped in on self-storage. So how are you guys setting yourself apart from getting those self-storage deals done, and making sure that they happen, versus, I know they're conversions. I know you guys are doing some other aspects, but how are you guys beating out the competition, especially in this competitive market?
Yeah, we've always been, I would consider it to be the ugly stepchild of the real estate world. I was like, well, I'm into apartments. That's the real form of investing, for multifamily as opposed to self-storage. But for me, it's like I can get as many rental units. We did 400 units, and it was a $100 million project. I can get 400 units, and it will cost me less than $10 million. There's tremendously less amount of risk associated with it. Plus, our operational expenses are 25 to 35% compared to 55%, and so there's just a lot more economies of scale and better efficiencies within the product type. So those are some of the things that we really enjoy about the marketplace there. The other aspect of your question was, how do we view this, or, how do we differentiate ourselves compared to our competition? And for me, it's the same answer as before, in the sense that not too many of my competitors are buying existing buildings. They're not buying buildings which we're converting into self-storage, or they're just building new ones. I can ineffectively build one for 35% less than what they're building new ones. So I have a price competitive advantage there. If we expand, we have a lot greater ability to understand the expansion and then modeling it out because of our development and design build background. So again, that's how we distinguish our products, is that we're able to offer a lot more services, and have a better understanding of the cost and the control mechanisms within the product type.
Got it. And what areas are you guys focusing all across the United States on these deals, or are there certain states that you guys are focused on?
We're focusing predominantly on the Midwest right now.
Okay.
What we call the flyover states, and secondary type markets. We feel that the East Coast, Florida, Texas, California are very heavily saturated, and so those are not markets that we're jumping into. We're looking at markets that are underserved.
Got it. And how big? You guys run a team that's looking at everything. How big is the team that you guys are running to make sure that you guys are efficient?
Well, we have our director of acquisitions and our director of construction, and those two are, the three of us make up the primary core team, and then we have staff underneath each of us to help us facilitate it. So, we have he began as an intern during COVID, and then we made him an employee while he was doing remote school. So he was actually working. And then when he would take class, he would stop and then go over to his laptop and watch class, and then he'd come back and keep working. And so we have him helping out on the sales and acquisitions. But then, as we bring on new projects, then our team expands because we're bringing on more right now for we're beginning our development in Louisville, Kentucky. And so that's, 144,000 square foot building that we're converting. And so we're expanding for that. And then, as we transition to other projects, then we'll have new staff for that as well.
Got it. And what would you say from, especially now with the, how quickly escrows are going, from a day that you guys identify a property to a day that you close on it? How quickly is that from due diligence phase to, escrow and everything else? So obviously you're not an escrow right when you see it, but, how quickly are you guys doing that look up, make sure that it's a good property, and then moving forward to making an offer and then into escrow?
The soonest we've been able to close is 60 days. And
Okay.
That was our Dayton project where, the seller had, it was a cash deal and we had to close. The one we're working on in Ohio right now, we've been tied up for probably 6 months in the due diligence process. The seller's supposed to be providing us with a survey, and we haven't been able to get, an accurate survey. I don't know why it takes 6 months to get it, but they're subdividing this piece of property. And obviously we've done as much as we can, but until we get that survey, we obviously can't close. But, we've gotten things over to the municipality based upon it. And, it's out of our hands at that point in time. And, eventually if it doesn't go forward, we'll just pull the plug. But we've invested a lot of time in it. So, we're being patient.
Yeah. Is there any money that's hard in that deal, or is it?
Oh, no, it's all contingent right now based upon the fact that we don't have the survey.
Okay. So with you guys doing, most of these things where you're able to win these deals, have you found some challenges or issues that you've ran into getting deals done? It doesn't matter this market or, the last 7-8 years that you've been in this, and how have you been able to overcome those challenges?
Well, we've had recently a couple challenges with the local municipalities. We were supposed to be able to get PACE financing through the Department of Energy with the city of Dayton, and they basically held up our zoning. I mean, we were zoned as of right, but they held up the PACE because they wanted us to, zone the building differently. And, we had to hold out and work through that issue with them. Basically, they wanted a coffee bar in the first floor. And so I negotiated with them that, we would open up the space for a coffee bar. And if it didn't rent after X amount of period of time, then it would revert back to self-storage. And, we came up with 9 months, and, we told them the rent that we had to be, which is the same rent per square foot that our lockers were going to get. And they wanted us to cut the rent by 80%, and they wanted a 2-year. I'm like, if it's so in demand, why am I cutting the rent by 80%? That's ridiculous.
Yeah.
So we gave a $3 per square foot concession, and we agreed to a year. And it was funny because, the neighbor called us up and said, well, we hear you don't really want us to rent this. And I said, well, we're open to renting it. That's why it's on the market. And they said, well, we'll pay you this. And then we expect, call it $140,000 of tenant improvements. Basically, I was going to be, paying them to rent my building for 5 years. And I said, no. I said, here's the rent. This is what my agreement is. If you want to pay it, great. If you want improvements after that, you're on your own. And they go, that's irresponsible for you. That's irresponsible for you to demand that. I can get better terms somewhere else in the city. And I said,
then go there.
have at it.
Yeah.
It's not irresponsible for me to pay you to be in my building. I go, that's your choice and that's your situation, but that's not mine. And so, it got back to the city, I had a feeling it would, but it was the type of thing where, they were, because we got a letter from the city that we weren't cooperating. And I said, here's the price.
Yeah.
It's as simple as that. They didn't want to pay the price. So
did you guys end up getting that rented out as a coffee bar?
No, I mean, right now it's still in the market,
Okay.
And, again, if it rents for that, fine, we'll put it in. If not, it's going to revert back to self-storage. But I told the brokers to set the price exactly at the limit because I didn't want to be accused of the city of, overly negotiating the deal. If we don't get a clean offer, then the market has spoken. Then we'll make it self-storage.
Yeah, that's huge. It's kind of crazy that you guys were pinned into that situation, but at the same time, there's random things just like going through permits or something like that. You could probably attest to that. The city wants something completely different than what you really had, drafted up or thinking of, and you got to put it in. So, barring that issue, have you guys at times put in a self-storage and had the numbers all penciled out and then ultimately had incorrect numbers on revenue, ROI, and everything else once you start renting them out? Or are you guys, and if so, how are you guys able to combat that, if any?
Yeah, I mean, are we perfect? Absolutely not. I don't think anybody is. That's your question, right? Have we been perfect? No, but we've been, in baseball, if you hit 250 one out of 4 times, you're considered good. I think we're above 250, but we're certainly not 1,000. But yeah, I mean, have there been errors? And that's one of the beauties of self-storage. For instance, in one of our buildings, the 10 by 10s were not renting, but the 10 by 20s were renting up. We couldn't have enough 10 by 20s. And so, we came up with the idea of removing the wall inside the 10 by 10s and making them into 10 by 20s. And so, penciling out, we actually dropped the number of units, but our gross amount of square footage of rented increased because we were able then to rent up the 10 by 20s. So we were able to get more rent by just changing the configuration. And so that's one of the beauties of self-storage. When I was in multifamily, we couldn't do that. You had X number of 1 bedrooms, X number of 2 bedrooms, and X number of 3 bedrooms. And maybe you could change the interior design a little bit better to make it more attractive. But, your unit, you're confined by the unit configuration.
Yeah, that's a prime example of being pigeonholed when you have a multifamily. Granted, outside of, being able to fix it up and reposition it, you can't knock a wall down, then all of a sudden make a, 4-bedroom, 2-bath, right away. That it takes a lot more, and it's, you have challenges, and ultimately, typically you can't do that. But with, like you said, self-storage, you're able to knock the wall down. That was a good workaround, and be able to put you guys into a better position and make that gross rent even higher. So good troubleshooting there. So
we didn't even really have to knock down the wall. All we had to do was unscrew it and then screw it onto the other wall. So that way, if we needed it later again, we could bring it back.
That's nice. Knocking down the wall, reframe, and all that other stuff. You can leave that alone. So, you said, getting into it, you guys have been doing self-storage for 7-8 years. Before that, you did, single family. You did some multifamily. What was the catalyst to get you into, outside of, granted, the numbers and the allure to self-storage? What was the biggest catalyst to get you over to self-storage versus, the single family and multifamily?
Oh, it was the crash. I mean, the crash occurred. And so, everyone's world was turned upside down. Fortunately, we were only sitting on a $3.5 million home at the time and a $1.8 million home. A lot of my competitors were sitting on property that they bought for, $1 million plus, and we're trying to figure out what to do with it. But, we were fortunate enough that I saw the market coming to a head. I didn't predict why, but I just saw a lot of indicators suggesting that there was going to be a downturn. And so we stopped buying, and it was a matter of, everybody was being pushed into multifamily because of the lending. And I just saw huge cap compressions and massive competitions. And it was when my clients, exposed me to, he wanted to find distressed self-storage, and I couldn't find it. I couldn't find any distressed self-storage. And that's when I began talking to him about development and how, developers are the ones that make the big bucks in real estate. It's not the flippers, it's the developers. And we began exploring, developing self-storage.
So you bring up a good point, especially people that I talked to that were in real estate prior to the crash. There's some that I do talk to and they say, I was in one thing and I changed to another, an asset class, and they were able to see it was coming. And I have a good friend that does development investments in Southern California, where I'm from. And he talks about, being a part of his escrow company and seeing a lot of difference back in 2005, way before the crash happened. What were some indicators for you that you saw where you had to pull the throttle and reduce it and put you guys into a position where you guys can obviously, reap the benefits a couple years later?
Well, there was multiple indicators, really. I wouldn't say there was just one. So one indicator was when the Fed was predicting a housing bubble burst. The Fed certainly wasn't talking about the over-truncation of the mortgage debts on multiple layers of it that, became very known during the movie The Big Short. Yeah. But, when the Fed was talking about, that was one big indicator, because when he began talking about the internet bubble busting and then the stock bubble busting, shortly thereafter, there was a downturn. So I was paying attention to the overall news. The second thing is I was seeing guys who had no business being in my industry were now my competitors. So that was like dentists, doctors, attorneys were becoming real estate developers. And they had no understanding of construction. They had no understanding of, other than the fact that they see this happening in their market. And so they felt that they could do it. Another indicator was the guys that I had hired were now becoming my competitors. So and I fully believe in the American dream in terms of how real estate and construction is still out there for the American dream. Yeah. And I mean, the first house we built, the guy, it was framed by a guy who was from Poland, who was right off the boat and could barely speak English. It was, I had to learn how to communicate differently when I began actually building single family homes, because when I was building multifamily, they were all union jobs, and now they were all non-union jobs. So my electrician was right off the boat from Russia. Our carpenter was right off the boat from Poland. Our floor guy was right off the boat from Poland. Obviously, there were other trades like from Mexico and different things like that, were painters or drywallers or landscapers. And so, asking for invoices, asking, to sign contracts, these guys, didn't have the ability to read these things. And so we'd have to give them to their lawyers and explain things to them and stuff like that. But when those guys were becoming my competitors and, becoming so developed and so quickly sophisticated that they began buying properties and had the abilities to buy property and get loans, where I had people backing me in terms of the size of the loans. I mean, we were buying properties for $1 million and building $3.5 million homes. I mean, that is not, your quick little fix and flip, right? I mean, no. That's a significant investment. Yeah. And so when these guys had that ability, I was like, holy cow, this is accelerating really fast. I mean, we're not talking like 10 or 20 years. I mean, we're talking like 3 years, 4 years. Yeah. And so when I was seeing those things and doctor and dentists coming into my marketplace, it was like, and people overpaying for properties. If it was listed for $1 million, it would sell for $1.2 million. And I'm like, this is just crazy. And so it was all those factors that I see. I mean, right now I'm seeing that we're going to have a recession. Okay. I think we're in for a downturn. When the administration is talking about changing, we've seen it already impacting fuel. Fuel jobs have left. Fuel prices inflated dramatically. We're seeing the change in the tax structure, capital gains tax, the shelter and capital gains. How basically the tax code, if it gets implemented, is going to be going after the real estate industry in terms of the traditional shelters that we've had for 30, 40, 50 years.
Yeah.
And that's ultimately going to, people are going to be pulling back, and, 1031s are on the table. I mean, that's a major tax structure which people have been utilizing.
Yeah.
And the capital gains. I mean, here's an example. If you inherit a house or an apartment building, and now all of a sudden you owe $1 million in taxes, and it's not producing that in cash flow, then what's your alternative? You're going to have to sell it, and people are going to have to be dumping properties and stuff like that.
Yeah.
So I believe that we're going to be in for a downturn here if the trend continues in the direction that we're going.
Yeah. So I was going to get into that, and sometimes when I do ask people, like, "Hey, what are your thoughts on the market? What do you think in the next 2-3 years?" They're hesitant about talking about a downturn, or they're hesitant about even putting their name on what they're thinking that's going to happen. So you think in the next 24 months we're gonna see some type of dip, especially with the tax reform, which I know they're going after 1031 exchange, also the capital gains going up to potentially 50%, and all those things that are really outlined that we haven't seen in the last, like you said, 30 to 60 years. Are there some other indicators that you see? I mean, so if you look back in 2007, 2008, 2009, you see a lot of different foundations that were broken because there was a lot of things that were not really tightened up as a foundation for lending, to making sure those people are qualified to purchase those homes, right? Or get a loan, like you said, commercial loans as well. So what do you see now outside of, let's take the taxes off the table. What do you see now outside of that could potentially expedite that downturn?
Well, there's been a tremendous amount of spending in order to keep the economy going. I mean, technically, March of 19 was not even a true recession because we only had 1 month. I mean, a true recession is 2 downward trend negative quarters, and we only had 1 month. But it's still being hailed as a recession. But because of that, there was a tremendous amount of spending. And so there's a lot of currency that was pushed into the marketplace. And, there's only 2 ways to address a recession. Is either, monetary policy or a fiscal policy. So the interest rates are at their all-time low. We don't really can lower the interest rates too much more. And now we're experiencing inflation. So there's even pressure for the Fed to raise the interest rate to keep pace with inflation. So if we can't lower the interest rate, then that's going to impact people's willing to invest. If it's less buying power, they're going to buy less stuff. So that's one aspect of it. But then the second aspect of it is just how much money is being pumped into the economy. And, that bill is growing and growing and growing. And so when you have that combination of those 2 factors, I think it's upward inflationary pressure, but then resistance to lowering the interest rate to spur the economy. So, to me, the 2 different policies right now are contradictory to one another.
Yeah. Do you see, and those are good points. Do you see, for instance, if you look back over a 50-year trend, back in like 91, 92, when you were getting into it, there was a market downturn that affected the housing market. And then also back in 2007, 8, there was a housing crash. Those 2 in particular decreased the housing prices. The other ones outside of those 2, there was a small dip or maybe plateau, and then those prices went up. Not significantly, maybe, a 2% a year. Do you see something like that? Let's talk about, overall, and then focused on the housing. Do you see this type of crash or bubble that's coming up in the next 24 months? Do you see it affecting houses like it did in 91, 92, and 2007, 2008? Or do you think it's more of a plateau for them and then, more focused on another aspect? Granted, I know you don't have a crystal ball.
Well, I think the housing market is going to be a little bit more specific based upon which area you're talking about. So if I just take here in Chicago, my neighbors' houses have traded twice in the last 10 years, and it's for less money than what they originally bought it for. So in fact, they put, a couple $100,000 into the house and they sold it for $100,000 less. So if I'm looking at the Chicago market, I'm thinking of it as we're still plateaued. It hasn't rebounded. My home will probably appraise at the same amount that it did, right immediately after the crash.
Okay.
So it's never rebounded to pre-crash levels. But obviously, if you're looking at markets, let's just say, Texas or Tennessee or North Carolina or Arizona, where the housing market is exploding, is because people are, fleeing the areas where there's, greater pressure on the economy, and they're going to areas where you have lower tax rates. I mean, Chicago's lost the equivalent. I mean, not Chicago, but Illinois has lost the equivalent of its second largest city in terms of migration. People are leaving the state. So obviously there's less demand, it's going to impact the housing pricing. But conversely, if you look at Texas or those other areas, I mean, I'm hearing of people, making multiple offers, and, it's going, 30-40% more than asking price. And, to me, those are signs of too aggressive a growth, that there's going to be some sort of correction as well. But obviously, if people are continuing to move there, there's going to be demand. So, I mean, the only thing that's spurring that is, more and more people are moving into it. Florida's a little bit of an anomaly because, there's a tremendous amount of people moving to Florida, but the overall population is staying the same.
Yeah, so I mean, I guess you and I are kind of in the same boat. I live in California. You're over in Chicago, and we've had a lot of people moving to different states, the ones you just named, and also Tennessee. So you have this exodus of people. Ours, I remember reading an article. It was the tail end of last year, which was Q4, where there was basically a net loss of 120,000 people in California leaving, and we obviously lost those seats too, as well, just because we ended up losing more people after doing that consensus as well. What I see, ultimately, at least for us, and I work as an active residential real estate agent over here in SoCal, I see, the thing is I see still multiple offers being had on every property, prices that don't really justify at times the price point on what we list at, and then ultimately people moving into the state, some people moving out of the state. So that's kind of a wash there. But mostly I see, the price is still going up. And then I also see, not as many fundamentals broken as there were back in 2007. So, I mean, at least, as you and I go back and forth with this, I feel like in the next, 24 months, if there is something that does happen, it would be more of a plateau in prices, depending on, like you said, the area, and then also depending on, ultimately what's affected the most. Is it travel, or is it tech, or is it venture capitalists, or is it real estate?
Yeah, absolutely. I mean, that's why I agree with you that there's not one answer for the single family market. I think you have to look at it per market share.
Yeah, for sure. Well, so for you guys in building this company, what do you see in the next 3 to 5 years? What your goals are, kind of what you guys are reaching for, and how are you setting those, and how are you accomplishing? How are you guys going to accomplish those?
Well, we set out on a 5-year plan to have 10 assets within 5 years, and so we're on pace for that. And so the idea of it is to acquire and develop a portfolio and have it worth over $10 million, and move it on to get cap compression with that by selling to a mid-level REIT. And so part of what we've been doing is developing that brand. But now that we have one-stop self-storage, we're putting it all under the same umbrella as well. And so the other aspect of it is we're part of a larger networking community of self-storage operators. So we're making sure that we have continuity between our deals in terms of the reservation software, the accounting software, so that way we can, if we want to include other developers or other owners into that portfolio, then we have that ability. Yeah.
No, that's good. Especially having that system in a place, because obviously later down the road, if you guys, build it to 20, 30, 40 million or whatever that may be, you guys can eventually sell the whole portfolio to, a big hedge fund or whatever that may be. So,
absolutely.
So outside of that, you guys have all building your business, being able to, where I'm going with this is, seems like you're super busy. Seems like you've been able to build a successful business. How are you able to balance that between, family life and then also building the business and being on top of the ball, looking in different areas for different deals? How are you able to do that?
Well, I would say it's not one thing. It's this culmination of a few different things. So, being self-employed, there is the burden of you're constantly thinking about your business, but then there's times where you can just unplug and take some time. So, fortunately, I've been able to do that with our kids and our family. And so, I've been very blessed and thankful for that, especially this summer. My daughter graduated from college, but came back before a graduate program. And so we've had her and my other two kids here, as well as and some of their friends. So it's been a very busy time, and we've been able to rejuvenate through that. Another thing I've been doing is making sure that we have systems. Our systems are, we've been really focusing on that. And then within our division of our companies, everybody's taking responsibility for their own division. And so we have a lot more accountability within that. And so part of what we did is our org chart is set up to make sure that we're holding that accountable so that we can track that more effectively. And then I would say the third thing is I've embarked this spring on a 2-year journey I've called the Transformation Center, which is just focusing for me on leadership. So quarterly, we step aside and we go on a retreat, and we focus on different elements of leadership. And so that is something that I'm investing in. It's like 2.5 days every quarter. And so that's the other area where I'm focusing on that.
That's huge. I mean, I could definitely say that as a leader, running a team, it's tough, especially when you start out thinking that you're going to be able to run it, as smoothly and as easily as, you look at other people as successful like yourself. And then ultimately you run into some barriers or some walls, and you're like, okay, well, I got to readjust. So it's always good for, people like yourself, and then, any type of business owner, to continue to educate yourself and learn along the way. How do you guys use accountability methods to make sure people stay on task?
Well, within our org chart, each division is responsible for a product that helps develop our overall product.
Okay.
And so if we're looking at, let's just say, we determine that we're behind in construction, are producing our product, we don't necessarily begin looking there. We go back 2 steps, which would actually be the accounting, to make sure that that division is good. And if that division is good and we're still experiencing the problems in construction, then we have to focus in on construction. Because that's how we identify what the issue is. So, if we're looking at, if it's marketing, if it's sales, if it's investor relationship, we always go back to and then assess that one. And if that division is meeting its performance, then we know that we have to focus in on the area that is. And if not, then we focus in on 2 back to make sure that that division is good. And so we have to be willing to be honest about those things. And so, part of what we also do is our leadership team, we do also do retreat where we pull back. We the last time we rented some townhomes up in Lake Geneva and on a golf course. And, we started going through 5-year plans and saying, okay, where do you want to be in 1 year, 5 year, 10 years personally? And then also business wise. Okay. And then said, okay, fine. If we're all in agreement upon our goals for these things, and we allowed everybody to talk without interrupting and just present. And then we went away and we reflected back upon what the other people had spoken about. Mm-hmm. And then we came back as a whole and said, okay, what were the feelings? What did you come away from that? And again, no one else could talk. All you could do is just present, and without interruption. So there was no right or wrong. It was, this is what I took away from that. And it was really cool because I learned some other new things about the guys that I'm working with. I'm like, okay, you really have this goal, this desire to do this. That's really cool. Okay. So if we're going to do that, then how does this translate? So then we had very tangible things that we said, okay, if we're going to accomplish these things, then we have to make these next steps. And it became a lot easier to do that. But more importantly, we also said, if we're not efficient in this, if we lose 20% efficiency, that turns a 5-year goal into a 6-year goal. Yeah. It basically adds another year. So we all have to keep in mind that if we're going to do this in the time frame that we want to, then we have to be efficient, and we have to be honest in saying, are we being most efficient about this?
Yeah, that's huge. Taking out, basically doing a retreat with your team members and talking about it, and then being able to, have them present it. It really gets, I guess you can say, the juices flowing to be able to, feel comfortable to present that, and then also be open to, get some feedback so you guys can ultimately get them to, get you guys and also the business to that 1, 3, 5 year goal that you guys set, and they set in place. So that's cool.
And it's just not my goal. It's just not theirs. Yeah. It's all of our goals. We're in agreement on those things.
That's cool. And that too, and you've probably found this out, but that too is also, align the company probably even a lot stronger, to be able to, know they can, fall back on you, or anybody can fall back on each other to be able to build each other up to get them to that goals.
Absolutely.
So let's transition a little bit, have a couple more questions, and then we'll get you out of here. But the first one, I want to see, especially you talked about systems, and it sounds like you guys are pretty patent on those systems. What online tool or what online resource or app are you guys using that's helping your business out today be more efficient?
Well, the online, our CRM is one of the things, but then we have a CRM for our investors which we've spent a lot of time the first 6 months of the year, in conjunction with also opening up one-stop self-storage, of a resource for our investors so that they can go in and see all their investments across the portfolios. And so rather than having them piecemealed, now it's all under one umbrella. And so that was a big alteration for us, is getting all that online. So from a reporting standpoint, from an accountability standpoint, from just, giving updates, they're all now in one centralized location. And, so they can pull up the monthly reports, or, the tax returns or the operating agreement, whatever it is, it's all in one central location.
That's cool. Yeah. That'll definitely make it more efficient. What about, Scott, a book, resource that you've used and read over the last, time that you've been in real estate that's really helped you and your business and your real estate grow?
Well, I think one that has, transformed how I've done business is The Road Back to You by Ian Morgan Krone, Krohn. It is not a relative, so I'm not getting any royalties from this by the plug. Different spelling, and but it's helped me understand other people and also myself better, so that I can relate to where they're coming from. So everybody in the company, we have them read the book and then personally assess for themselves which one of the 9 characteristics they are. One of the rules of the book is you don't tell anybody what they are, but you let them tell you. And then based upon that, then you can have a better understanding of how to interact. If it's our customers or other people that we've been involved with, then we can make educated guesses as to what we think they are, but we certainly don't tell them. But we've changed our communication style and the way in which we do business with them. So in that way, we can relate better. And so it's what we found to be a very incredible tool. And this tool was developed by 4th century monks. These guys had their act together. I don't know how they came up with this stuff, but it's unbelievable how accurate it still remains today.
I haven't checked that book out, so I will. Okay. And so if people are looking around for you to get a hold of you, maybe ask you a question, where can people do that and find out more about you? Well,
thanks for asking, Peter. First of all, if anybody from the show wants to learn more about self-storage, if they reference this show and they email us at info@coda, CODAMG.com, we'll send them a free feasibility report. And the feasibility report is historic of something that we've done. And they can see why we did what we did and the market, but it also explains the market as a whole in general. And so it's just a great resource that people can have. And so we will give that to anybody who emails us and specifically mentions the show. The other thing they can look at is our CODAMG.com is our webpage, as well as One Stop Self Storage, and that's all spelled out, and you can see what we've been doing there.
Okay, cool. Well, Scott, this has been a pleasure. It's been awesome going over, your business, what you've been able to accomplish over the past, 30 years, and pretty much everything you've done, and also talking about, self-storage and being really, really efficient at it and also growing the business very successfully. So I appreciate your time, and I'm very happy that I got you on the show so you can talk about it.
Well, thank you for having me. I appreciate it.
Yeah, of course. Thanks.